If you own a home or property investment and have a mortgage, you need to watch this. I'll keep this brief. About 45% of homeowners have a mortgage, and the majority of buy-to-let properties have mortgages. So it is quite likely at some point, if you own a property with debt, that you're going to need to refinance or remortgage a property. In fact, 1.4 million of us will remortgage over the course of this year alone in the UK. In this video, I'm going to explain what refinancing is, and importantly, when refinancing your property, it makes sense, even when your term hasn't ended. But before I get into it, full disclosure, I'm not a financial advisor. However, I have spent the last 12 years building one of the UK's largest home buying brands, as well as my own multi-million pound property portfolio. So I'm going to share what I wish someone told me when I got started. So, what are the basics of refinancing or remortgaging? Now, firstly, to be clear, refinancing and remortgaging are the same thing. It might surprise you, but I get asked that a lot, and it is essentially different names for the exact same thing. The difference between getting a mortgage and remortgaging is with a remortgage, you are applying for a new mortgage product to replace an old one and staying in your current home or keeping your existing investment property. So if you're sticking to your current mortgage provider or borrowing more money from your current lender or getting a brand new mortgage on a brand new property you're buying, that is not defined as a remortgage. The reason that distinction is important is in 2023, the total mortgage market value is expected to be about £285 billion, and 89 billion of that, about a third of that, is taken up by remortgaging or refinancing of properties. So a third of people out there, a third of mortgages being taken up is by people switching to new mortgage products from previous ones. And there are some really good reasons why. Let me share them with you. The main reason people switch is to improve the deal they are on. So we all know that if you don't shop around every year for better rates on broadband, mobile phone contracts, mortgages, really anything, you're going to end up paying more. It's unfortunately common practice that providers will often edge their pricing higher or not lower their pricing to match competitors because they know a portion of their customers won't go through the hassle of switching. The customers that don't switch are effectively paying what's called a loyalty penalty. In fact, Citizens Advice published that regulators found 1 in 7 customers are essentially paying a loyalty penalty despite the cost of living crisis. And what is shocking is specifically in the mortgage market, it estimates about 630,000 people are essentially paying about £1,000 a year more than they should on their mortgage, compared to if they just shopped around for a better deal. For so many households and investors, a mortgage is going to be your biggest cost. So although many of you may be sitting there content you're on the best mortgage product possible, even if this video triggers just one of you to think twice, to look to remortgage, to potentially save you and your family £1,000 a year, then this video would have been worth making. But when do you know when to remortgage? Now, that is the key question. Currently, 74% of mortgages are on fixed rates, typically between 2 and 5 years. So although you may have signed up to a 20 or 30 year mortgage term, the percentage interest rate will only be fixed for an agreed timeline. So 1 year, 2 years, 5 years, in some cases longer. The real benefit to this is you know 100% what your mortgage cost is going to be month by month, year by year, for the entire length of the fixed rate. So even if interest rates go up or down, your monthly payments aren't going to change. So most people look to remortgage as that fixed rate is coming to an end to replace it with the best fixed rate available at the time. However, there is a better way to decide when to remortgage that, and I'll get into that in just a second. The remaining 26% of mortgages are on variable rates. Most people want to avoid variable interest rates as your repayments will change if interest rates change. So if interest rates go up, which they have been doing so, your payments are going to go up, which is far from ideal. That is why variable rate mortgages are getting less and less common, as this graph shows. This graph shows the percentage of new mortgages being selected at have fixed rates. So since 2019, although 26% of total mortgages are on a variable rate, the graph shows that about 96% of new mortgages or remortgages are actually on fixed rates. So there's only about 4% of new mortgages at the moment that go onto a variable rate mortgage, which proves how undesirable they are in the marketplace. Most of that 26% of people on variable rates I mentioned a moment ago are unfortunately people that aren't able to get off them because they can't find new fixed rate mortgage products to switch to, which is why the segment of the market is sadly called mortgage prisoners. But when is the best time to remortgage? Well, in a nutshell, the best time to do this is when you can get a cheaper deal, even if your fixed term hasn't ended. So many people just wait for the fixed term to end to trigger when to remortgage, when sometimes you can get a cheaper deal sooner. Now, of course, if you remortgage before your fixed term ends, you will likely have an early redemption charge. So if you've got a year left of your fixed term, for instance, you might have to pay a 2% penalty on the mortgage balance. And the longer you've got left, that usually increases the percentage penalty. Now, it is sometimes worth paying the penalty if you can find a lender that can provide you a mortgage product that saves you more than the penalty. So you might have to pay a £5,000 penalty, for instance, but if your new product saves you £6,000, you're £1,000 up. The best way to keep track of this is to diarise to speak with your mortgage advisor at least annually to double check you can't be saving money on a better deal. It can literally save you thousands. If you don't deal with a mortgage broker, you are mad not to in the vast majority of instances, because they can run these calculations for you and compare against all the different mortgage products available to you to get you the best rate. Whereas a high street bank, for instance, is only going to show you the products they offer, not the cheaper ones you might be able to get elsewhere. I'll see you in the next video.